crude oil is at a multi-month high above $87 a barrel. To assess the impact on oil marketing companies, Harshvardhan Dole, Senior Vice President, Institutional Equities of IIFL, joins in. Harsh, hi, good morning, and thanks for joining in. So, OMCs have been in focus. In fact, there was quite a bit of selling pressure that we saw last week as well on this entire pocket. With Brent crude now at $87 a barrel, what are your thoughts? You've had that fuel price move as well. How do you see OMCs, the stock move play out from here on?
Hi, good morning. So for us, OMCs continue to offer deep value, and not only OMCs, but the PSU pack in general. And the reasons are as follows. While there has been an uptrend in the oil in the last 15 odd days, it's largely because of supply curtailment rather than a runaway increase in demand. So historically, we've seen that whenever there is a supply curtailment and crude reaction, it doesn't last for a very long period in time. So unless one is hoping that, there is a strong China recovery aided by India and the rest of the world, and therefore world runs out of oil, our view is that oil should actually guide it anywhere between $75 to $85 a barrel for next at least 12 to 18 months. And were that scenario to play out, I think the macro for oil marketing companies or the PSUs in general will be fairly benign. And the earnings volatility will be much lesser, earnings predictability will be much stronger, for which we actually continue to like the entire PSU pack.
Got it. Okay, all right. Hi, Harsh. Morning. Good to see you in. So you continue to remain positive on some of these OMCs. What about the city gas distribution companies? Do you think that the price cut was due to the oil minister's comments? We spoke to the management of MGL and they didn't think so. And also I wanted to ask you, will the super high EBITDA margins normalize now for IGL and MGL?
Well, IGL actually doesn't earn a supernormal margins, in my opinion. Their existing margins are still in the region of around 7 to 8 rupees, as compared to some other players whose margins is actually in double digits. So IGL and Gujarat Gas actually continue to earn much more reasonable margins. And in fact, these companies ought to earn much more were they to recover the cost of capital for the investments that they are making in the new areas. So in my opinion, the margins for IGL and Gujarat Gas are fairly okay. Other players may see some volatility depending on the LNG price and the price of the alternative fuels. And therefore, our stance on the sector has been at a price you buy IGL, at a price you buy Gujarat Gas. And it's going to be more of a trading sector for some time, given the fact that there is going to be emergence of EVs and propane, etc. It is going to be sort of, buy and trade in, trade out kind of sector.
Harsh, hi, good morning. And that price has not come yet, right? I mean, when we spoke with you after that set of regulations, you were saying maybe a little lower. Even, we're at about, 1260 on MGL. So another 10-15% from here?
Prashant, actually, between all these three names, we would be more comfortable owning IGL, and that too at a price. Other two don't actually inspire that confidence, even with a 15% correction in the stock price. For us to buy into the other names, the stocks have to correct even much more. I think IGL is the only name that actually stands out well to us in the pack of those three. So I will maintain my view that I will be net buyer in IGL below 400 rupees.
Okay, yeah, I remember 400. So we're about 406, so around about there. Now, just another thing, right? Yesterday, names like MRPL and Chennai Petro rallied. They were up 5-6% in otherwise down market. And the reason seems to be that a lot of some estimates suggest that 15% of Russian refining capacity has basically been taken out because of the Ukrainian drone attacks. I mean, the war which is going on. So 15% of Russian refining capacity has gone off stream. Does it provide a lift to sustainable lift to sort of gross refining margins? And then what does that mean for standalone refiners? And also, do any of the oil marketing companies benefit out of the three? Yeah.
No, absolutely correct. In fact, when we did that analysis, nearly 15% of Russia's refining capacity is under attack as of now. Russia typically exports about 2 to 2.2 million barrels of products, mainly to Europe and the other parts. Were theoretically the attacks to intensify, these product movement will be at risk, and that too at a time when the product market is undersupplied. So we are closely watching how this scenario unfolds. And we'll retain our view that for a very long period in time, maybe next 3 to 4 years, the refinery margins are likely to remain above the historical averages. And that is the reason why we think the refineries who can process opportunistic, oil will be in a sweet spot.
Okay.
Do you have coverage on MRPL and Chennai Petro? I mean, even if you don't, you must have looked at where they trade, valuation versus historical, etc. I mean, is there value in these names after? Because they've run up quite a bit. My question is only on the back of that.
I think the reason why we don't rate them is the earnings sensitivity of changes in GRMs is so high that $1 change in GRM moves the kind of EBITDA by almost 20 to 25%. And to that extent, we prefer to play this whole theme through the integrated companies such as PSUs. And that is the reason why we continue to like somebody like an IOCL or a BPCL as compared to the standalone refiners.
Okay, got it. I also wanted your thoughts on names like GAIL and Petronet LNG. With the lower spot LNG prices, do these stocks look good now for the medium to longer term?
I think the LNG weakness story, in my opinion, can be best played through maybe a Petronet, GAIL, or interestingly, even companies like Torrent Power, which have got surplus capacity or other untied capacity in terms of, power offtake. For example, Torrent currently has close to 1.5 gigawatt of open capacity. And this is at a time when LNG prices are benign and the merchant power rates are actually inching up fairly strong. So if they are able to contract capacity at fairly attractive rates, plays like Torrent Power can actually be far more interesting plays than utility names like Petronet or GAIL, which actually have quite a few other businesses. So in my opinion, if one name that stands out well for this merchant power story, it's Torrent Power.
Okay, all right, Harsh, final question before we let you go. ONGC and Oil India, what's the view out there?
Very cheap. We continue to like them. I think there is very less downside at the current price. And, if ONGC's volume growth story were to unfold, I think the stock can continue to give relative outperformance versus the market.
Okay, thanks a lot for joining in, Harsh. Appreciate your thoughts. Have a good day. Well, that's the word coming in on the, oil and gas stocks for now.